Higher rates are good for stocks, and here is why. If you've been around the stock market and interest rate market of the last handful of years, one, the stock market's been predominantly run by technology stocks, Apple, Microsoft, Amazon, Google, accounting for a lot of the S&P 500, even more of the NASDAQ. And with that, what is synonymous almost across those technology stocks, high growth. They like to take any money that they get in the door and invest it in higher returning future products and whatever they want to build. And when interest rates are higher, it's harder to access money to fuel that growth. It's a contractionary period, right? When interest rates are high, and that can be especially harsh on those technology stocks. And so how could higher rates be good for stocks? Well, we're going to dissect it because we've seen recently some really interesting action in the stock market directly coming off of interest rate activity in the US and abroad. And let's start with the US and the US FOMC meeting in September, whereby the Fed came out with what you would call probably a more hawkish stance. They didn't hike interest rates, but they were on the side of some more contractionary action out of them, which is to say they said, we're not hiking today, but we still have other hikes on the table in the future, and we're not looking at cutting interest rates anytime soon, which would, if you've been around the last couple of years, everybody who's long technology stocks are almost hoping for that interest rate cut to fuel that growth. But what we saw with this more hawkish contractionary type statement was the stock market moving lower by 1%. If you're looking at the S&P, that was a net change on the day, which, okay, might confirm your suspicion, right? Oh, well, the potential for higher interest rates, stock market moving lower. Yeah, Frank, that's what we've been thinking. And that's why we think you're crazy to say that rates might actually be good for stocks here. Well, then you had the Bank of England come out not even 24 hours later, and they were actually expected to hike interest rates another 25 basis points higher. They paused interest rates and actually spoke to several times in their comments global economic volatility and the fact that GDP globally is not growing as much as they'd expected. And they're worried about the European economy as well as the Asian economy. And that a pause to interest rates and the potential for them to be lower there, essentially across the pond, the opposite type of statement, a dovish statement, saw the S&P 500 move lower by almost 2%, almost double the amount there. And so which outcome is actually better for the stock market? Is it higher interest rates? Is it lower interest rates? We've looked at those two case studies, but now let's look at some thorough data around this. And first, I just want to highlight the theoretical, and then we'll pit it against the actual practical. Here you have the S&P 500, and the idea would be over the course of the last 20 years plus, higher interest rates, increasing interest rates from a central bank is theoretically going to slow the economy. It is literally called contractionary central bank activity. And in a way, this is what central banks globally have been trying to do the last 24 months. Inflation shot up. The stock market was screaming through all-time highs after the pandemic. That brought the price of goods and services higher. Inflation shot up. And so they were like, we need to cool this economy down a little bit. We don't necessarily want the stock market to crash, but we need to cool it down. So we're going to increase interest rates here. And the initial knee-jerk reaction to that in 2022, 2023 was the stock market moving a little bit lower. But now that things have shaken out a little bit, and we've been in a high interest rate environment for over a year, the stock market's bounced back. a little bit here in 2023. And actually, if you look historically at now in black, you have still the S&P 500 over the course of the last 20 years plus since 2000. And now in blue, you have short-term interest rates from the Treasury. You'll see a very interesting story here, which is when do you see stocks moving lower predominantly? Well, it's actually coinciding with low interest rate environments. And there is a little bit of chicken egg situation here. Well, central banks move interest rates lower because stocks are crashing and the economy isn't doing well. Well, yes, that is true. Poor stock performance does lead to lower rates. What I thought was especially interesting is not necessarily, the '08 financial crisis where you see interest rates down at 0% in the stock market, as you can see there, printing some of the lowest prints of this entire data set. And then you have there the pandemic, some huge moves lower there in 2020 and interest rates falling all the way down to 0%. So yeah, one kind of causes the other. They happen simultaneously. It's not necessarily that interest rates are low and that's why the stock market fell. But what I thought was even more interesting is some of the most, some of the most all-time high inducing periods for the S&P 500 over the course of the last 23 years were when interest rates were moving higher. If you look back to 2016 to 2020 in there, interest rates are climbing off of 0% for the first time since 2008, when the financial crisis was in full bloom. And you had the S&P 500 printing new all-time high after new all-time high. I mean, look at that period from 2016 until the pandemic, interest rates marching from 0%, where they were knocked down to after the financial crisis, all the way up to 2%. And in that time, you might remember some of the most boring trading environment, but some of the most consistently higher and higher stock market, almost day after day, it seemed. And you see plenty of new all-time highs in that period. And then also recently, you've seen interest rates not move necessarily from 0% to 2%, but 0% all the way up to 6% at certain points for short-term U.S. Treasury bills. And the stock market, yeah, it's been a little uneasy, but has been able to fight back close to those all-time highs. And this could be a little bit of a blip towards newer all-time highs in the future. It's definitely not necessarily interest rates higher. The stock market can't possibly move higher with this contractionary period, was able to consistently make new all-time highs as interest rates were being hiked by the Fed. And now we're seeing chances of high rates for longer climb. You have here the distribution of essentially likelihoods of where interest rates could be at the end of next year. And if you want to take a look, go to the CME Group website and spend some more time with this. But what each of these lines moving up and to the right essentially means is chances of higher interest rates have been climbing, because all these lines signify 4%, 4.5%, 5% interest rates. And as they've moved higher in the last couple of weeks here, that's telling you that the chances of 4% or 5% interest rates at the end of next year are climbing. Those chances are climbing that interest rates will stay higher. Whereas people, you can see a couple of months ago, thought there was a near 0% chance that rates would be 5% back in June and July. And those odds starting to climb of higher interest rates for longer, which we've just seen, can coincide with all-time highs in the stock market. And here's the thing, my friends, the flip side of this coin We want lower interest rates. We need lower interest rates for our economy to outperform, to continue to do well, for our GDP to can keep seeing a positive growth rate, for our stock market to continue to see positive returns year after year. Well, you have here EWU, the UK stock ETF. They just paused interest rates, and their stock market is now only up 2-3% on the year, and has been moving lower the last couple of days, potentially giving away any profits. And then you have in the green line, the Chinese stock ETF. And of course, there are a bunch of things going on in China politically and everything else. But keep in mind, they never saw that high inflation. They never had a reason to increase interest rates. Their GDP has actually been seeing some of the slowest growth of the last several years. And those things are all synergetic. It's almost like if your economy isn't confident enough to increase interest rates, that's not a good thing. If you've got a low interest rate environment, it's probably because your economy isn't moving in the right direction. So here, a little bit of a bull case for higher interest rates, because the opposite side of that story, lower interest rates, usually induced by stock volatility and downside.